The auditors signed off on the reports. They were all lies. Amaranth Advisors, once a towering giant in the hedge fund world, was about to crumble into financial oblivion. Founded in 2000 by the ambitious Nick Maounis, Amaranth quickly gained a reputation for its audacious high-risk, high-reward strategies, peaking at a staggering $9.5 billion in assets by 2005. However, the seeds of its downfall were sown in the very foundation of its aggressive approach, which prioritized bold market plays over conservative investment strategies. Amaranth's early success was fueled by a team of talented traders who made their mark by delivering exceptional returns. Among them was Brian Hunter, a Canadian trader whose expertise in energy markets quickly became the focal point of Amaranth's strategy. By 2006, Hunter was the star trader responsible for a significant portion of the firm's profits. His aggressive bets on natural gas futures had paid off handsomely in the past, and his confidence in his strategies was unwavering. But as the summer of 2006 drew to a close, the natural gas market began to shift in unpredictable ways. In early September 2006, Amaranth made a series of aggressive bets on the natural gas market, specifically on the spread between winter and summer contracts. These bets were not mere gambles. They were high-stakes wagers that left the firm dangerously exposed. On September 14, 2006, a single day of trading resulted in a shocking $560 million loss, a prelude to the impending disaster. This initial blow was a harbinger of the chaos that would follow. The market was shifting unpredictably, and Amaranth's precarious position was about to unravel with catastrophic speed. As the days unfolded, the losses multiplied at an alarming rate. By mid-September, whispers of Amaranth's distress began to spread through financial centers in New York and beyond. The hedge fund, once celebrated for its audacity, was now teetering on the edge of collapse. Investors were panicking, desperately trying to withdraw their funds, but the market's awareness of Amaranth's dire situation only fueled the fire. The firm's liquidity issues were exacerbated by the rapid exodus of capital, creating a vicious cycle that was impossible to halt. September 21, 2006 marked the peak of Amaranth's implosion. Total losses had skyrocketed to an astounding $6 billion, approximately 65% of its assets under management. The decision to liquidate the fund was inevitable. In a matter of days, one of the largest hedge funds in history had been reduced to a cautionary tale of unchecked ambition and speculative trading. The rapidity of Amaranth's downfall sent shockwaves through Wall Street, leaving many to question the stability of the financial system and the vulnerabilities inherent in hedge fund operations. The human cost of Amaranth's collapse extended beyond financial losses. Hundreds of employees faced job cuts, their livelihoods shattered in the wake of the fund's failure. Institutional investors, including pension funds and university endowments, were left grappling with the fallout, trying to comprehend the massive losses incurred. The collapse shook the financial world, prompting urgent discussions about the systemic risks posed by hedge funds operating with minimal oversight. Regulators were forced to confront the uncomfortable reality that the hedge fund industry, largely unregulated at the time, posed significant dangers to the broader financial ecosystem. The root cause of this disaster lay in Amaranth's overexposure to the natural gas market, compounded by inadequate risk management strategies. The fund's aggressive trading practices and failure to diversify investments left it vulnerable to market volatility. Amaranth's downfall was a stark reminder of the perils of speculative trading, where the lure of massive profits often blinds firms to the inherent risks. The lack of a robust risk management framework meant that Amaranth was ill-equipped to respond to the rapid market changes that ultimately led to its demise. The lessons from Amaranth Advisors' collapse resonate today, serving as a catalyst for change in the financial industry. It highlighted the urgent need for better risk management and regulatory oversight in the hedge fund industry. In the wake of Amaranth's collapse, calls for reform grew louder, leading to increased scrutiny of hedge funds and their trading practices. Financial regulators began to implement measures designed to increase transparency and reduce systemic risks, though debates about the appropriate level of regulation continue to this day. The financial world learned the hard way that unchecked ambition and speculative trading carry devastating consequences. Amaranth's collapse underscored the importance of foresight, caution, and regulation in the volatile world of high finance. The story of this once mighty hedge fund remains a stark reminder of the dangers lurking in the shadows of unchecked financial ambition. For those who lived through the debacle, the memory of Amaranth serves as a constant warning of what can happen when risk is ignored in favor of potential reward. In the end, Amaranth Advisors' story is a cautionary tale that echoes through time, a narrative of hubris and the high price of failure in the financial sector. It underscores the critical need for stringent risk management and the importance of regulatory frameworks designed to protect investors and maintain market stability. As markets continue to evolve and new financial products emerge, the lessons from Amaranth remain as relevant as ever, urging caution and prudence in an industry where fortunes can be made and lost in the blink of an eye.